Welcome back to Bull on the Street, ladies and gentlemen. My name is Nicholas Coriano. I'm joined with my partner.
Dan Wachtel.
Good afternoon, Dan. Today we're going to talk about IPOs, initial public offerings. Dan, what's an IPO?
An IPO is when a private company trades on the secondary market, which is the NASDAQ or the New York Stock Exchange, for the very first time.
Exactly. It's basically when a private company is listed on a public stock exchange for the very first time. There's more stock exchanges than just the NASDAQ and the New York Stock Exchange. There's other stock exchanges like Australia has a stock exchange, London Stock Exchange.
Yeah,
There's the Tokyo Stock Exchange. The stock exchanges all over the world.
and they're everywhere.
They're everywhere. Exactly.
You got the London Stock Exchange, you got the Philadelphia Stock Exchange, you got Chicago Stock Exchange. You have a stock. Do you have pretty much a stock exchange everywhere? You may just not know it. You got the Boston exchanges. Everywhere has got an exchange.
Yeah.
Israel exchange.
Yeah, everywhere. Like you said, even where's Buffett? They have an Omaha exchange. So yeah, so that's what a public an IP initial public offering is the first time. Now there's a lot of procedural steps in an initial public offering. There's form filings with the SEC. There's investors that you have to bring on board, investment banks you have to bring on board, investor relations firms you have to bring on board, the right management. Why are some of the reasons somebody would do an initial public offering, Dan?
Well, if you're going to do an initial public offering, some of the reasons are prestige. Some of the reasons are they want an exit. I mean, if we're going to be real about it, some people want an exit from their company, or some people want to bring in a large amount of money for the company.
Or they need to bring in a large amount of money for the company.
Well, if we're talking about, like, let's say a Facebook IPO or a LinkedIn IPO or a Google, one of the larger IPOs, they did it. They went public because they really had no other choice. And when they went public, so when you go public, you have this whole road show you go on. You tell everybody about your company, even though they know about it. You get,
You tell investors about your company.
Investors, you go to broker dealers, you get indication of interest. Then the brokers go to their clients and they sell it to individual investors. And once that happens, they go public. Whatever that brings in, whatever that price is, first strike price, whatever that is, that's what the company raised. So if they were trying to raise, let's say, 1 million shares, and they did it at $1, they raised $1 million. After that, it's the investors, and the company does not get any more of the money.
Exactly. They're in the secondary markets now. That's why the investment bankers do it, right? They do it for the big up. If they can buy your stock for $1 private and then make a market for it and sell it at $3, $5 at the IPO, that's a windfall for them. And then of course the investment banks and the brokerage houses are going to make money when they trade, right? So when it goes in and out on the floor of the stock exchange, the brokers like Morgan Stanley, Merrill Lynch, Bank of America are going to make money off of the trade on each one. Some of the things I've seen for initial public offerings is, again, some of them are forced to do it because they have too many shareholders, the shareholder count. Some of them want to do it because it's an optimal time. People are throwing money at them and they have a viable business and they can use the cash injection. Some of them do it, as Dan said, to get out. It's an exit strategy. So there's a lot of reasons why you do it. Dan, the first thing I found funny that you said the first thing that was prestige. Definitely in the smaller market, it definitely is a very prestigious thing when done correctly. And I think we've alluded to this in some of our past casts that when you don't do it correctly, you have this fictitious prestige and a large bill for being public, because it does cost money to keep running a public company. So if you don't have that, you know, if you don't have the money coming in, it's gonna be a hard time staying public. But
Sometimes, like you alluded to it earlier too. Sometimes the board of directors they vote to go because they have, because it goes with the exit strategy, because they've been with the company for a long time, mainly with stock. And when you go public in a very liquid market, like one of the the national stock exchanges, when you go public that way, you get a windfall. Like when they hit that button, no one ever is crying.
yeah, no, absolutely. Yeah, and you said the key word, liquidity. You said the key word, liquidity, right? So when you hit that New York Stock Exchange market, that NASDAQ market, and your investor relations team did a good job and created a market for your stock for investment bankers and broker dealers and even the secondary investors, it's a windfall. It's a windfall for you. The better your company is and the more profitable it is, the more known it is, the easier it is to have an IPO for sure. If you guys want to learn more, check us out at Servitude. Email us at bullonthestreet@gmail.com if you want to talk about this podcast. And we'll talk soon, guys.